All right, welcome, guys. It is January 4th, 2024. My gosh, guys, that's nuts. 2024. Here, let me see if I can get my beautiful face in here. You ready? Don't get shocked. You're gonna see my big mug here with my headphones on here in a minute. You ready? We tried. We tried. Tried showing my beautiful face here, but um. All right. So the main thing that I am going to go over today is what I am looking for in 2024 is a continuation of this bull run, and I want you to apply what we're learning throughout the year and right now. It's a great example of right now. Now, one of the main questions that I get from everybody, because everybody comes to me after the fact, right? Is, did I miss my opportunity? Well, no. The answer is simple as no, you didn't. What I want you to see here is, do you see over here, right? Can you guys see this blinking? We are still at 2020 COVID levels, right? We are still at these lows of these financial crises that we had. This had to do with Europe and blah, 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 blah. So, what does that mean? We still have huge opportunities. Yeah, I'm recording. I am recording. Okay, so understand market breadth, right? We are still at the low end of market breadth, okay? Now, what usually happens is people begin to jump to bonds because they think they're going to outperform, right? Like, why are you going to buy a bond? Like, why did I just put in a bond that's going to get me 5% interest for the next 2 years, right? Well, because I think that 5% is going to do better there than somewhere else that I would stick it, right? Well, what ends up happening is people think the equities aren't going to do as well. They start buying up these things, and you can see the last time we were this high was when? Right before we had the rally from the GFC, right? Okay. Now, one of the things that you're going to notice that I do throughout the year is I'll go through every month and every week to make sure all the data points are still lining up. This is what I did last year when we were buying the dips, okay? Now, profit outlook is improving and climbing. Okay, profit outlook improved from a net 36% to 26% expected global profits to deteriorate, right? Profit outlook tracking in line with lead indicator, ISM manufacturing new orders to inventories. So you can see we started to get this curve, right? But we're still not above what I would call the middle point, right? We still have a lot of room to go. Now, what happened to equities after the great financial crisis, right? As we started, boom, we shot up. Now, one of the things that's happened with this market is everybody started cutting the fat in preparation for a recession. So what does that mean? Higher profits, right? Which leads to better ratios. Okay, now this is the FMS sentiment improved to its highest level since January 2022, right? Yes, that's true. But where are we, guys? Everybody's saying we move too far too fast. Maybe we get a little pullback, but ultimately we're still way, way, way down here, right? So we've got lots of room, and I think we're just getting started. Okay, and I'm going to go through all this data, and I'll go through a lot of the common questions. But I want to show you data points that show you how we have room to run. Okay? So did you miss the opportunity? No. We're just beginning this journey. Okay? Now, do we need a correction? The most common statement I've been hearing of late is we've gone too far too fast. Right? So, how far have we come? We're not even at our historical average of stocks within 10% of record highs. Here's your historical average, and we're still down here, right? Before a correction, we would need to see 45 to 55% up in this range, right? Correction, boom. Correction, boom. Correction, boom. Correction, boom. We're not going to have a correction, guys. We've already had it, in my opinion, right? This is all my opinion. So we need to start climbing up into this range before we start talking about a correction. Now, there's a difference between a correction and a quick dip, quick buyback, a garden variety 5 to 10% pullback, right? Give me one sec, guys. It's stuck. Huh? Okay. Okay. Now, one of the things I want to go over is, do we need a pullback? And learning to love the pain. That's my mantra for the year. Love the pain, right? How many of you guys work out? You know, my little boy's just starting to really work out, and he says it hurts and blah 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 blah. And I have to tell him that's how you grow, right? That's how you grow. You got to feel the pain, right? So, do we need a pullback in the short term? Yeah, probably so, and we're getting one, right? However, when we experience these pullbacks, zoom out, right? And learn to love the pain and look for opportunities in pain. Well, what does that mean? That means do the hard things, right? So, one of the things I want to show you here is if you look at the charts, and this is something that I'm doing literally right now. If you look at Amazon chart, I'm buying today, right? I'm buying today, but it's very painful. Why is it painful? Because it's scary. Maybe we're going to go down a little bit, right? So I'm looking at this as an opportunity versus, we've pulled back, I'm scared, right? And this is what we have to train our brains to do. Learn to love pain. Short-term pain leads to longer-term gain. Okay? One of the things that I said last October, I was buying this breakdown right here. Does everybody see that green arrow? Was anybody in the room? Does anybody remember the feelings in the room? Everybody was freaking out. Everyone. And I was like, guys, this is great. This is great. This is setting up perfectly, right? The reason that everybody's freaking out is because this is a technical breakdown. Technical breakdown on the SPY, right? We're going to go back to 350. But guess what? I saw opportunity, right? I said, hey, you know what? How did I handle this pain? I said, I'm buying some more Google. See 1025? I will add at 121, 122 area as well if we get there. I'm buying these dips in the strong names. I bought the NVIDIA 400 breakdown. We're close to a short covering rally. I'm going to position for it, take profits into it. Look, Meta murdered. I don't know if you guys remember. Meta had earnings, murdered. And I'm buying some. Yes. All this pain that I'm experiencing, I'm thinking, let's go. Give it to me. I want it, right? Starting a long-term position in GNRC, it was at the worst possible spot from a technical level that you could possibly think of. Look at this date, 1031. Let's go to GNRC and look at 1031 right here. Right here. Like we are at the lows and we have broken down yearly consolidation. But I said, you know what? Short-term pain, long-term gain, right? Same idea. So these are all examples. I could literally do this over and over and over, and I could show you this stuff all the time, right? Remember we were debating the low on Netflix, right? Very risky trade. I'm willing to buy Netflix when it looks like this. Painful. It's scary. Why? I said, I think the low is going to be at this 340 area. I think that's where we're going to bounce from. That's as low as we're going to get. So I'm buying some, and I was able to take it back for $100 gain. And I'm still holding some, guys. I'm still holding some from this buy, right? So what we do as traders and as day traders, we get so myopic and we look at the day, the week, and even the month. And we're like, it's scary. Man, since July, August and September and October have been horrible. I've got to sell everything. No, you don't. In fact, know what you own and think of things in value, okay? One of the things I want you guys to think about this year is value. Everything that you do, I want you to think about it in value. Everything. So let me give you an example. I am sacrificing an hour of my time while my kids are home, while my wife is home. I will never get this time back with my kids, ever. This hour that I'm giving up to do this with you guys, I'm giving it up. That is a valuable thing to me, to be able to spend an hour with my kids, wife, or they're home from school, we could play, right? Everything in life is about value and risk reward. So why am I doing it? Well, a number of things. Whenever I put this together, whenever I present it, it burns it into my brain, right? And so when I'm struggling and when the market's pulling back, I'm going to come back and I'm going to be like, remember my presentation? Think about it in value. So this is going to help me a ton when the market's pulling back 5%, 7%, 10%. And I'm going to be like, let's go, right? So what is value? You know, value is what you get. Value is what you get. Now, price is what you pay, right? So a lot of times you guys will say, hey, what do you think about this stock? This is what it's doing. And I'm like, I don't know. I really don't care what it's doing because this is one of my long-term value plays. So like BABA, I don't care what BABA does. I know what I own. And what I own is a stock that is at such low ratios that is producing so much cash that it could buy back its entire float in 3 years. It's ridiculous. It's crazy. BABA, go to $5. I don't care. I'll keep buying and you'll buy back your entire float and then we'll be able to sell it, have another IPO at 5 times as much as what it is. I don't care. So how many of you guys could have taken $100 per share off of this company? How many of you have ever done it? Think about value because that's what allows you to do this, okay? All right. Now, what I want you to do is think about value and pain when I show you these things, okay? 1026, right? I'm buying NVIDIA for a swing, no stop. Bought some Amazon to hold through earnings. Bought some Microsoft and Google as well. Remember all the pain? Here's your gain, right? Pain, gain. All of these. Pain, gain. Pain, gain. How many of you guys were with me when Google was coming down here? Remember at the beginning I said, hey, if it comes back down to 121, 120, I'm buying some more. I bottom ticked this thing, right? How many of you guys were here when Google came out with earnings and it was like, why is it selling off so bad? This is great earnings. Sure, their cloud didn't do what it wanted to do, but that's like saying McDonald's didn't sell as many salads as they wanted to. Big deal. It's an overreaction. I start thinking of value and not price. The value that I can get Google down here at 120, well worth it. Well worth it. Because this is what runs the market, guys. I don't care about technical analysis. I don't care about anything like that. Value runs the market. And when things start getting lower in price, their value begins to increase. And you're not going to have valuable things stay unvaluable for very long. Sometimes it can, like Baba, but in the overall general sense, it's not going to, right? Okay. Now, again, value, love the pain. That's what we're going to focus on. You're going to hear me say this over and over and over. Okay? Value, pain. Okay? The thing that I want to really focus on here is, how many of you guys have ever heard of the term max pain? Right? How many of you have ever heard the term of what people say, the market makes it as hard as it can for the most amount of people as possible, right? Pain. Everything in the market is about causing you pain. And if you can't get to the point where you enjoy the uncomfortableness of the market, I don't think you should be trading it. You need to get to the point where you enjoy the uncomfortableness. And one of the things, guys, that I do to do this is I literally put myself in positions that provide bodily pain. I don't know if you guys have ever heard of the cold plunge. You know, Gary Brecka talks about it. But I've done this for a long time. I did it from my days of playing basketball. I get in cold baths, ice baths, right? Get your body used to experiencing uncomfortable situations so that you can enjoy it, okay? Now, once you start experiencing this pain, zoom out. Zoom out and think, is this something that I really need to think about fundamentally? Or is it just a blip? Is this just a blip? Right? And I can tell you what we're going through right now, a 2% pullback on the indices, that's not even a blip. It's not even going to register on the charts. Now, one of the things I want you guys to really understand is what this Excel sheet that I'm going to show you right here, okay? How many of you guys have ever heard of dollar cost averaging? Okay? Put a 4 in chat if you have heard of dollar cost averaging. So, what is dollar cost averaging? Do you guys know? All right, a lot of you guys have. How many of you know what it is? Can somebody put it in chat? What is it? What is dollar cost averaging? And you know, again, I taught myself VP, so maybe I'm using incorrect terminology, but the way that I interpreted and use dollar cost averaging is you're buying over time and you're averaging into the price so that time doesn't affect you as much, right? Like the price going up and down, it's not that big of a deal. Okay? So here, I want everybody to take a screenshot of this Excel sheet. And I want you to pull up the SPY. Okay? Everybody pull up your SPY chart. And what I want you to look at, I'm just gonna drag this over here, okay? SPY. Well, actually, let me pull up this SPY. Oops. What I want you to see here, let's say I'm the worst, I have the worst luck in the world, and I decided that I was going to start investing in the market at the beginning of 2022, okay? This is when I'm going to start investing in the market, right here, right at the beginning of 2022, okay? And this is the absolute worst timing that you could actually have. Like, I'm top tick. I'm starting right at the top tick. Come on. How unlucky can I get? Right? Well, what would have happened if I would have been dollar cost averaging within the SPY when this was happening? Right? Where would my average be? All right, well, let's go back and look at this Excel sheet. Look, I bought 10 shares on January 1st, 10 shares February 1st, 10 shares March, all the way through to the end of last year, right? Well, I would have had 240 shares and I would have spent $99,000. Well, what am I sitting at now? So let's just say 470 is where the SPY is. So let's bring up a calculator. And I would have say 240 times 470. I got $113,000. So what have I made? I've made $13,000. And it was less than the 100,000 because this is over time. So what's my return on this? It's about 7.5%. Guys, 7.5% with the worst timing. Hey, I'll take it. You know what I mean? Like, think about it. People are tripping hand over feet to get into these bonds that are selling at 5%. Like, come on. I have the worst timing in the market and I'm still at 7%. Right? Now, if you've got good timing and you know how to play things like I do, then this just is amplified. You can still dollar cost average, but you know when to really start heavily breaking in. So, guys, does this make sense? This is something that I want you to understand dramatic, like I can't emphasize this. So, let me give you an example on BABA. I've been playing BABA, I think it was right here, is when I first got in, which was the middle of March. I've been dollar cost averaging in, and I've been selling rips up into 100, right? And so, boom, boom, boom. I'm still holding pieces of these buys that I bought all through here. And I'm dollar cost averaging. I'm buying on dips. I'm selling some on rips. And I can't promise you, but I think BABA's coming back to 170. Okay? I think BABA's coming back to 170. So as I'm dollar cost averaging in, if I get the rip, man, I'm set, right? Like, if I were to tell you the amount of money I have in BABA right now, you guys would probably freak out. But if this happens, like, my great-great-great-grandkids are going to be set, right? So the same idea applies no matter what you're doing. PayPal. You think PayPal's a good company? Great, do it. Amazon. Great, do it. You can do this on anything. The trick to this is what? What's the trick, guys? The trick is to not pick companies that are pump and dump biotech stocks that people try to pump up and dump on you, right? We got to find good, valuable companies, right? Good, valuable companies. Larry. Yeah, I pretty much have already, haven't I, Larry? I mean, come on. Okay, now we're going to move on to the next slide. When you begin to approach the stock market as investing versus I got to make $1 million today, you begin to understand how all the good people that make money play it. Even bad timing trumps inertia. So perfect timing, here's your output, right? Investing immediately, just put all your money to work right here, here's your output. Dollar cost averaging, here's your output. Bad timing, here's your output. But if you stay in cash, if you're like, you know what? Let's just pretend you've got 200,000 in like horrific assets right now, like just crap companies. And you're like, you know what? I think I can make a little bit of money back. I'm just going to stay in this instead of taking out all that money and saying, let me invest them in good companies. Well, this is going to what your return is going to look like, right? So if you're sitting on bags that you bought, I don't know, somebody from another service told you to buy because it went from $1 to $5. You bought it at $5 and now it's at 50 cents. It's dead weight. You're not going to make your money back, right? Find money that you can invest and invest in good, valuable companies. Okay. Um, and to be quite frank with you guys, this is going to be my schedule going forward. I'm going to be doing more and more of this. The last few years, I've been doing less and less trading and going in size on value plays. And this year is going to be another cutback on some of my trading. Now, this is a slide from my 2023 plan. Guys, I kept telling everyone that the next 12 months can determine your wealth in a decade. Okay? You see, I was emphasizing this. I was like, guys, I want you to understand this next 12 months can change your life. And I made more money in the last 12 months than I've ever made in my entire life. And I've made millions. I made $4.5 million in one sitting, right? When I sold my sport clubs. But I made more money in the last 12 months than I have ever. And that's because I was positioned. I was ready to go, right? Now, what was I doing? I was investing in great companies at heavily discounted prices. Value is the key to being successful. I'm going to be looking for more value in 2024. Some of those places are emerging markets and small caps. Okay? REITs, in my opinion, are also presenting possible value buys. Okay? Now, last year, I said, hey guys, we're at the 25% pullback level. This is where I'm really starting to go. Right? I said, hey, statistically, once we reach 25% pullback, within a year, you're green 80% of the time. Within 2 years, you're heavily green 100% of the time. Okay? These are the kind of things that I do and I trade. Now, some of those examples, I'm going to give you a couple charts right now, and I want you to think about value, not about price action. Okay? You ready? Here's one, and I got to be honest with you, this one's kind of makes me a little shaky. But Disney. I was buying Disney around 80, 85, buying it down here. Can anybody tell me a company that has a bigger moat? Do you guys know what a moat is than Disney? Does anybody have a bigger moat than Disney? Do you guys know what a moat is? When I say a moat, does anybody know what that means? So pull over your Disney chart and yeah, like a moat is something that provides a defense, a barrier of entry type idea, right? Who's got a better library of entertainment than Disney? Nobody. Now, are they screwing it up? Are they doing stupid stuff? Did they buy Star Wars and try to go woke? Of course, yeah, they did. But I believe Disney is going to right that ship, and they're going to start having good returns. Okay? This is a valuable company to me. I think buying Disney around 80 or 90, I promise you in the next 2 years, I'm going to come back here and I'm going to be like, you know what? Disney's reached its level. I'm going to be selling this. I don't think Disney's worth $200. Right? I'm going to sell it here at 190. Okay? Now, here's another one. And, unfortunately, this is kind of shot out before I could have this presentation. But I told you guys last year I was buying this all through here. Right? So, C is the other one. So pull up your C chart. C is known for not performing as well as some of the others, but I think they got their act together, and I think it's valuable down here at 40. I don't care that it broke its recent low, and the technical analysis says we should pull down. Well, guess what? Many other people thought that too, and that's why it didn't keep going down, because we found value here. This is how the market works. These things that are valuable are not going to continue to go down because people are going to say, this is down too far, right? Yes, C as in Citigroup, right? So I am already up on Citigroup. 37, 38%, right? But guess what? I think we're just getting started. We're just starting to break over this group of people. And if you look at this, let me show you a yearly chart. Can anybody tell me, on the yearly chart on C, if you look at that, what do I call this candle followed by this candle? Right? The yearly chart. Does anybody know? The time frame is the yearly. What do I call this, guys? What happened on the yearly? We broke down, right? We broke the lows. So here's your other yearly candle. We broke the lows from the previous year. We rejected the breakdown, and now we're breaking up last year's high. So this is a rev strat. It's a possible reversal strategy because we cracked lows, we shook everybody out, and now we're breaking up. Anybody and everybody that was going to sell has sold. That's what this is called, a reversal pattern, rev strat, right? Broke the lows, and now we're going up. And if you look at it on a yearly, right? The yearly, wow, look how much room we got. I mean, my gosh. Are we going to go all the way back up to $600? No, probably not, right? But, you look at it on the daily and you're like, man, it's gone too far too fast. I can't get it here. Okay, great. Wait for a pullback. I don't care. But what I'm telling you is you can start buying right here and you can dollar cost average in a year or two, you're going to be up a good amount, in my opinion, right? Now, what about a REIT? Here's another REIT I like, Crown Castle. Okay. Again, we started getting in down here, so we're up, already another 30%, but I still think we have a long way to go. One of the things you're going to notice about some of the companies that I get into long term, and AMD is a perfect example of it, is they will have situations where they're temporarily impaired. This is the quote from Warren Buffett. Find good companies that are temporarily impaired, right? So why was GNRC temporarily impaired? Well, it was because they had too high of inventory, COVID, et cetera, blah, 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 right? What's wrong with Disney? Well, they've gone woke and they're starting to, suffer the consequences, and a lot of people aren't liking them. What about Target? Target's another one, right? Target had that, same idea, right? Temporary impairment. Bud is another one. That's the same idea, right? Temporary impairment. Now we're back up. This is what you want to find. Good companies, strong balance sheets. Now, the problem with CCI is they bought some fiber networks, and it wasn't a good investment. It wasn't good. And they're starting to get rid of those, trying to sell those off, and they're going to focus on their towers. And they're just going to turn this into a cash cow, right? And so here's another one that I love, okay? I'll go through some more at the end, but these are just three that I wanted to get you guys to understand value, okay? Now, the other thing, just so you guys know, is I trade the trader, right? I play technical levels still within these long-term plays that I like, okay? So once I start getting a good base and we start moving up, I will continue to add to that company and average up. A lot of people refuse to average up. I will average up. And so some of the companies that I was playing last year, right? Look at the companies I was getting at last year. Companies I like for long term. Apple, Microsoft, Amazon, Google, Crowd, PanW, Datadog, Cost, Netflix, right? All of these are the big companies that were, allowed for a 60-70% pullback on some of these companies. Let me ask you guys, do you think Meta is going to give us the opportunity this year to go from here all the way down to here. This is a 70% pullback. Do you guys think we're going to get that same opportunity this year? I don't. I personally don't think we're going to do this. This already happened. So guess what? Meta's not one that I'm looking at for a long term anymore. I'm still holding from down here and here and here and here and here, and I will continue to play it on a technical level. But this isn't a long I'm looking for on a long-term level. It's already done its move. So we need to start looking under the surface and stop focusing on the big seven, magnificent eight, and see what else we can find, right? Any questions on this so far, right? Value, value, value. These were valuable then. Are they valuable now? Yeah, they are. I still think they are. If I was going to pick two out of all of these, my favorites are Amazon and Google. Of all of these, it's Amazon and Google. Okay? I still think those are extremely valuable. Some of the other ones, we've made our move. They'll probably have 10, 12, 13, maybe 14% moves this year. But they're not going to have 100%, 50% moves, in my opinion. Now, do you guys know what a PE ratio is? For those that don't know, it's a way that people measure value. They'll say price to earnings ratio. They'll do forward price to energy. They'll use PEG ratios. They'll use all kinds of different ratios to determine value. But do you guys remember when I said, hey, I'm buying the XBI and I'm buying the S&P? This is what the ratios were when I was doing it. It was at the beginning of November. Just look at the gap. You're paying a 12 PE ratio on the S&P 600 small cap versus an 18 on the large. That's a pretty wide gap. In fact, the gap hadn't been this wide since 2008. So guess what? Value. Let me go buy value. So I started selling some Costco. I started selling some NVIDIA. I started selling some Microsoft. And I said, let me put some money in the small caps, right? So where do you think I think the majority of the gains are going to come from, at least in the first half of the year? I think it's going to be S&P small cap and mid caps. Okay? Small cap and mid caps. Now, if you don't know what companies these are, you can literally just go look at them. Pull up the S&P 500, look at the large cap, look at the 400 mid cap, then look at the 600 small cap. Figure out if there's any companies in there that you like. So let me give you an example. If you guys that have been with me for a while, you guys know I love CPS, right? Has it been hard to hold? Yeah. Here was a 200% push followed by a 50% pullback. Here was another 150% push followed by another 50% pullback, right? Do you think this affected me at all? Do you think I ever said, oh my gosh, I should have sold it at the top. I should have sold it. Do you think this is affecting me what it's doing right now? No, I don't care. I know what I own. I know the value of this company and I know the price target I'm trying to get it to. Right? So I view pain as an opportunity, short-term pain for an opportunity for long-term gain. Right? Now, I can go into more detail on some of these for you guys in other sessions. If you guys want, long-term sessions, if you guys want me to break down a company for you on long-term, I can definitely do that. But right now we just don't have the time. Needless to say, CPS Um, they were temporarily impaired. People were afraid that they were going to go bankrupt. They fixed that. They're good. And now they're running like clockwork. And you can tell because every time they have an earnings report, it gaps up and goes. Okay? If you guys want, I'll do that. I'll break it down. I'll break down some of these for you. Okay. Now, let me ask you guys something. Do you guys think there's a higher chance? And be honest, I don't care if you disagree with me. That's what makes a market. Let's just say, let's pretend CPS pulls back to 15 just to give me even numbers, right? Do you guys think it's more likely that CPS this year would go from 15 to 30, right? And that gives us a 100% gain. Or do you think it's more likely that NVIDIA goes from, let's say, 500 to 1,000? Which one's more likely this year for you guys? Like, seriously, answer the question. Like, whatever you think is where you need to put your money. If you think it's more likely that NVIDIA is going to go from 500 to 1,000, great, go for it. My personal opinion is CPS. That's just my opinion. And that's why I'm putting my money there, right? Now, here's the caveat. What do you think's more likely? Do you think CPS can go from 15 down to 10? Which one's more likely? CPS to go from 15 down to 10, right? And it gives you a nice little 40, 50% pullback. Or NVIDIA go from 500 to 250, right? And this is what you have to understand about the way the market works. For every reward that you're looking for, the yin and the yang is going to present the opportunity in the opposite direction just as much. It's more likely that CPS is going to pull to 10 than NVIDIA is going to pull to 250, right? Of course. So you have to understand these things, and that's why you have to find good companies and remember what you own. Remember what you own. I own a company, and again, the way that I picture this, guys, is I'm an entrepreneur. I literally came in and said, you know what? I'm going to buy this company, and they're going bankrupt. They're going to have to shut down all their stores. But you know what? I'm going to give you $160,000 for all these stores. Well, why was I doing that? Because I saw value. And within 4 years, I was able to sell it for $4.5 million. Right? This is what I did my entire life. This is what I've always done. I would go in and I would buy Subways that were run poorly, that were in great locations, that were temporarily impaired because of a bad owner. I would buy them out. They would lose money. I would double the value of the store. I would sell the store. Repeat the process over and over. This is all I've done. This is my life. I literally go places to find value. Okay. Now, let's talk about a little bit of technical here. Does everybody understand that there's a very big difference between technical and value? Right? Technicals don't mean anything. Values is what drives the market. Now, what technicals tend to do is they give you a hint of the value because value is often adjusted during earnings, right? So even though Microsoft may be selling off in the short term, once they have earnings, it's going to pop up because it's a good company that normally does well on earnings. What happens, guys, after we break out of 2-year sideways consolidation periods? See these blue boxes? Can anybody find pattern right here? Anybody? What happened after these blue boxes? Somebody find a pattern. This is what technical analysis is, guys. It's patterns. What are we doing? Yeah, you go up, right? 100%. It trended. For how long? How long did it trend? Yeah, exactly, Mel. You got it. Exactly. It's a giant squeeze, right? Okay? Now here's the other kicker. Before we went up, right? It's always safe to say woodpecker. You got it, Daryl. What happened before we went up? So after we broke this 2-year consolidation, what happened? You see these little blue circles? Right? It's always the correct answer. Woodpecker. Yeah, exactly, Jay. It's small dip and then rip. You see this little check back? Boop, rip. Boop, rip. Let me get all the chasers. Let me get all the chasers out. And then we're going to go. Right? So here, I'm going to pull up the SPY chart. Again, pull up your SPY chart if you want to follow along. If you can't see my chart. I'm going to go. Let's go to a weekly. All right, guys. When you look at this chart, and if you look at the time frame of when we broke out of this consolidation period, right here, which is the end of 2020, we literally had an 11% pullback. Does that look scary to you guys right here? Does this look scary? No, it don't look scary. I'm good. I want to take this rip. This ain't scary at all. Right? What about from 2008 all the way to 2013, right? What about these pullbacks? Were these scary? 15%. How scary are these? They don't look scary to me. They're literally blips, right? So here's your 15, 16, 17, right? This pullback was, this one was only 6%. We can handle that, right? So what I'm trying to say to you guys here is, whenever we get the pull, I don't know if this is it. We're getting it. I don't think it is. I think this is just a little check back before we actually start breaking out of the highs. And we get this garden variety 5 to 10% pullback. I'm going to be clapping my hands. I'm going to be rubbing my hands. I'm going to be saying hallelujah. And you know what? For everybody that's not listening to this session, for everybody that joins later in the year, for whoever's not here and doesn't watch it, you know what they're going to be doing? They're going to be going, and you know what I'm going to be doing? I'm going to be going, I love it. I love that they're scared. I love that they're shaking in their boots. I love it. You know why? Because that makes it easier for me to come up behind them and pick their pocket and take their wallet out and take all their money. Get scared, get shaken out, freak out, deal with it, use your emotions to make all your decisions in life, and I'm going to take your money. I appreciate it. Thank you. Here, why don't you just write me a check? Let's skip the middleman, right? That's what I'm going to be thinking, okay? All right. Let's jump to monthly seasonality now, right? I'm going to try to pick up the pace a little bit here. January, February, right? 45%, 54%, 50-50 shots right here, first 2 months, right? But look at March, April, and May. Guys, I am literally using the next 2 months. And guess what? I'm buying options out past May so that I can play these pullbacks, right? I am going to be buying these dips in January and February, and I'm going to be taking profits in April, May, and June. Okay? This is what I do every year. Right? And then you get another little pop in July, and then you get remember what happened last year? Your seasonality, August, September. Sometimes October actually pushes, and last year it didn't. Sometimes it starts in October. But November pushes. Look at that, 90%, right? Now, here's the other thing. What's special about this year coming up, guys? What is special about 2024 that's different than last year or the year before that? Or the year before that? Yeah, it's an election, right? Well, historically, what do we know about election years? Well, here's your average path of the S&P 500 during election years since 1928. Presidential primary season, look, we kind of go sideways for the first month of the year. I'd expect something similar to that. I think a little bit of, maybe a little trend up. But the end of the year, we start shooting up. So how am I interpreting this? I think small caps and mid caps are going to get some bids. I think the bigger companies are going to be a little bit choppier. And then I think we're going to start pushing into the elections because that's what they do. That's just what government does, right? Now, the year starts out pretty slow, right? Starts to pick up May, June. Right? This is just another chart to let you see if you want to use this one. Now, here is another chart you can use, and I'll share this PDF with everybody. Presidential election, Trump, Obama, all the way back to Hoover. And you can see the S&P 500 returns. You can see when a Republican was elected, 15.3, a Democrat, 7.6, all election years, 11.2, right? All right. Now, why am I doing this? Why am I so bullish? Because, guys, most people are bearish still. Most people are saying a recession's coming. A lot of my friends that I respect but think they're idiots on this particular instance, they're saying, hey, credit card debt's going up. They're going to start cutting rates. Cash is coming down. All these bad things. They're making bad case. But what they're not understanding is it's recency bias. And be honest with me if you haven't heard this, because I'll explain it if you haven't. How many of you guys have ever heard about the inverted yield curve? And it takes like a year for it to play out, right? We haven't gotten that yet. The inverted yield curve always leads to a recession when it's doing this for this long, right? How many of you guys have ever heard this, right? This is what everybody says. But guys, this happened in 1980. The same exact thing we're going through right now happened in 1980. And we didn't get the recession. So yes, in the last 6 or 7 examples, it's happened. But it doesn't happen every time. And you need to be able to look and see and say, why is it going to happen this time versus the previous times? What is different? Well, what's different is earnings are going up. Earnings are going up. Money is coming through. We're still expanding. Right? And so one of the things I want you to really pay attention to is margins. Okay? This is another theme for next year. Margins. Next year, margins are expected to rise another 70 basis points. So what does that mean? Well, if you're Zuck, if you're, Musk, whoever's running these big companies, right? Whatever company CEO is running your company. Last year, everybody was told recession, recession, recession. Let's cut jobs. Let's trim the fat. Let's save our cash, right? Let's prepare for the worst case scenario. What happens if we get the Goldilocks landing? What happens if we come in and it's perfect? Well, everybody took these precautions for no reason. Well, what does that equal to me as a stockholder? Well, what that means is my PE ratio is going to go through the roof, right? Because now I'm making more money, and even though revenue is not going up, say 30% or 20%, maybe revenue is only going up 10%, but I'm making more money per dollar, which means my earnings is going up dramatically. Right? And this happening quarter over quarter over quarter is what leads to chasing, because it's called exponential growth. You're going to go from, like, let's say PayPal comes out and they're trading at 11, and then everybody's like, oh, wow, they were trading at 11 beforehand, but with this new earnings report, it's actually trading at 8. Wow, I gotta buy some PayPal. It's at 8, right? And then they're going to buy it back up to 11. And then it's going to do it again, and it's going to be trading back down to 9, right? And then eventually, after a few quarters of this happening, they're going to be like, man, PayPal's crushing it. Why don't I get in it? Because they're going to have good earnings next time too, right? And so that's what begins the chase. Value, value, value. Now, you guys see the dates here? Everybody look at the dates, and everybody look at what everybody's saying. When I was first started trading, what I was told, when I started day trading, what I was told was, hey, you're a small fish. You want to just catch the crumbs of the big dogs. just you want to grab onto that shark and just let the shark do all the hard work, and you just pick up the scraps. Guys, one of the things I'm going to tell you that I continually learn, even the big dogs are idiots. They really are. They're so dumb. And last year is an example of that. So in 2020, guess who led the bounce? Retail. Guess who led the bounce last year? Retail. Even the big dogs are stupid, right? You've got a very few handful of people that are extremely smart, and they're not the ones putting out papers like this. Another Black Monday may be around the corner. Look, October 22nd. Well, let's look at the chart from October 22nd. Yeah. We are up 17%. Yeah, good job. Good job, moron. You're an idiot, right? Yeah, don't listen to these people. Ignore the freaking noise. They don't matter. They mean nothing. Okay? All right. What time is it? We got 1 o'clock? All right. This is a quote, right, from... How many of you guys put a 2 in chat if you've read The Intelligent Investor, Benjamin Graham's Intelligent Investor? How many of you guys have read it? I've read it. I read it every few years. It is a great book. If you haven't read it, you need to read it. But within this is a quote: published stock market predictions of brokerage houses, right? There's strong evidence that their calculated forecasts have been somewhere less reliable than a simple tossing of a coin, right? So you guys, when you come out and you're like, hey, this company got a downgrade and we're in it, I'm like, great, you're an idiot. That means I'm probably going up, right? Go as long as I need, Nate. You sure? I'll jump off, man. I can cut it. Just let me know if I need to jump off, and I'll jump off. I'm almost done. All right, let me see if I can get going a little bit faster. One of the things I want you to understand is use hard data, right? This was all, everything that I was doing with you guys, it was literally hard data. Cash as a percent of U.S. large cap fund, right? Everything that I show you guys is hard data. And this is what I was showing you over the years. Pension equity weights are at a 25-year low sell side. Bank brokerages, market targets are mostly underwater. Consensus long-term earnings growth for the S&P 500 is at its lows, right? Active fund managers are hugging their benchmarks, right? We don't top out when we're like this. We top out at euphoria, okay? Now, this is an important slide. I want everybody, yeah, Brock, it's being recorded. I want everybody to take a snip of this slide. Take a picture of it. Generational cycles lasting roughly 16 to 18 years. You can go through here and look at every single one of them. What happens? Deflation, reflation, inflation, disinflation, deflation, reflation, right? Where are we? We're literally in the middle point. We're in the middle point. I think we're going to be going for another year or two, at least. Maybe 3, right? So we're in the middle, and all we did, we checked back. We checked back to the trend line. We checked back to the moving average, right? And now we're off and running again. And I think we're going to continue, okay? So take a picture of that slide. The secular bull market has reignited. Normalized S&P price performance of a secular bull market, right? This is what we did in 1982 to 2000. This is where we are right now. And this is what we did from 1948 to 68. So no matter what happens, in my opinion, we're going up and to the right. And that's what we want to be doing. Okay? And this is another one you can kind of go over. Could the S&P rally to 1400? You know how Nate uses symmetry? This is all he's doing here. So this guy from RBC, he comes in and he's like, look, I think we could rally to 14, right? We could rally to 14. That's only right here. Okay? So is that a good target? Yeah, I think it is. I think it's a great target. Again, this is just the PE ratios so that help you understand value, right? Small cap is where my focus is from November of last year till at least the first quarter of this year. We'll see where we are after the first quarter. But what I want you to see here is small cap really performs well in the first half of interest rate peak, right? And then the second half it underperforms. So this first half is really what I'm trying to capture, okay? I'm targeting individual companies as well as the IWM. Now, the reason I put these slides in here, guys, is I want you to have the S&P earnings growth year over year for 2024. Look at healthcare, comm services, info technology, consumer discretionary. You can come in here and you can look and say, hey, which ones do I want to get into? And this is revenue growth, right? So info technology is actually supposed to have the revenue growth, comm services after that. And so you can start going through these and you can read these slides about what analysts are projecting, and then you can measure against them. So analysts are projecting an earnings growth of 6.2% and a revenue growth of 4.3 for quarter one. Well, what happens, guys, when I come in here and we're going through our quarter one earnings and we only grew 4% on earnings and 2% on revenue? I'm gonna have my ears are gonna be up. They're gonna be like, wait, this is not good. But if it's at 7 and 5, I'm gonna be like, hallelujah, we're on our way, right? These are the things that we want to keep track of. So keep all of these slides so that you can go back every week, every month, and make sure that we're staying on the path that we need to stay on. Okay? Again, you can come in here and you can look at forward PE versus 5-year versus 10-year average, right? So the forward PE, this is what this slide is. I'm just going to start ripping through these. Now, guys, does anybody know what the Hang Seng Index is? I am finding value right here. Now, just be aware, the Hang Seng Index has been horrible for a while, right? I personally am finding value. Well, who am I playing in the Hang Seng, right? I believe emerging markets are going to outperform, just like they did here, right? U.S. outperform here. I think we're going to have something like this for emerging markets. Well, what's an emerging market? India, China, right? Those are the two that I'm focused on. And guess what? Price versus value, right? Value, right? I got to dig. So guess what? Everybody knows this, but I'm going to put this out here so you guys can have the slides. Baba's revenues per share have grown 900%, cash flow 500%, earnings 500%. Yet we are still at the exact share price from the IPO. We've 10x this stuff, guys. It's crazy. It's absolutely nuts, right? Their share count is going down. Their cash they're bringing in is they're buying more shares. I think they bought 3 billion last quarter, right? They've got 13 billion more to go this year. They're going to buy back. I could go through here and I can show you all of their businesses, and this is how you dig. I can show you all of their businesses and what they do and how they're producing, right? And all the cash that is not being accounted for, right? And this is what you do. All these slides will be in here for you guys to look at, right? Increasing 53% year over year, increasing 20% year over year, right? Increasing 60% year over year, right? These are what we want to see, right? 25% year over year. And this was the negative one. It only grew 2% year over year. So the reason Baba got sold off was because we only grew 2% in the cloud. Okay, great. Let me show you something about the cloud, all right? This was Amazon, right? And this is Amazon now. December 16, boom. AWS, boom. Well, where are we? We're right on these same levels that we were. So guess what's going to happen in the next 6 years to Baba? In my opinion, it's going to look very similar to this. And the cloud's going to just freaking take off. And everybody's freaking out. And I'm going to be sitting back laughing at everybody and saying, thanks, Xi Jinping. Thanks, China, right? So anyway, here is, the year-over-year change, what you're looking for, right? These are the balance. This is what you want to see. This is how you want to these companies that break down, like how PayPal has Venmo and other things. You want to see these year-over-year changes that look like this. Okay. Now, to sum up, I'm looking for weak markets weak moments in the market to get long. I'm going to long valuable companies. I believe we get a pullback in January and February. If we do, I'm loading up for the April May push. If we do not, I'll continue to play shorter time frame swings into longer term swings. Right? Okay. That's it. Any questions on this? I will stop this recording and jump off so Mr. Bear can grab the mic back.